back now to our esteemed panel. Steve is still there. We still got to look through it. By the way, I'm trying to recycle the internet so I can compare the two. Francis, your immediate take on this decision?
Well, hearing about that dot plot, maybe it'll come in defense of the dot plot. There'll be a lot of comments about this being very political in nature, but this wide dispersion in views on this Fed.
The Fed wasn't political.
Well,
it's independent.
It's independent. Let me just say, because there's going to be questions about this, that there is a lot of confusion about the state of the U.S. economy now. It's not clear how much should the labor market truly be weakening. When will tariffs come through? And some of this dispersion we might be seeing in dot plots, some of it, not all of it, may very well be a reflection of the confusion of this economic moment. So we have to be careful about taking any headlines about the median dot here from what I'm hearing, because we have huge dispersion within Fed members. This is going to call more attention into absolutely who is going to be at the Fed and who is going to be leading the Fed not too many months from now.
I think this is actually really important that there was only one dissent. Because what that tells me is that even though Governor Bowman, Governor Waller may want the job of Fed chair, they're not willing to go against the consensus of the Federal Reserve in order to get that. I think that is a very, very positive statement. So, I think, Jay Powell is Mr. Consensus. He wants to get consensus. Clearly, he talked to everybody before this meeting. And to me, the fact that they're not going to fall over themselves to say 50 basis points now, even if they want more Fed easing, I think that's a very positive sign, because it says the Federal Reserve as an institution regards its independence as tremendously important, and they're not going to fall over themselves to do what the administration wants right now. And I think that's a very positive sign.
But our job, Jim, here is to look ahead. And if we are to assume that Stephen Byron or somebody else may become the next Jerome Powell, and that person is incredibly dovish, they want to lower rates, that maybe they are not entirely apolitical. What does that mean for bond markets? What does it mean for stock markets?
So ultimately what we have to think about is the framework that the Fed is working through, which is the Phillips curve. So effectively...
What is that?
So the Phillips curve is a relationship between unemployment and wage inflation. So if the unemployment rate is going up, wage inflation and therefore consumer inflation is likely to stay relatively low. If the concern is that the labor market's going to weaken, then they are very likely to be able to say, I'll look past 3% inflation today because it's not going to be a problem because the unemployment rate will be very high. So therefore, we might as well cut. That plus the balance sheet, which I mentioned before. What it means for markets, though, is that you're seeing now wage inflation stay relatively low and likely to stay low, which means that margins, profit margins, are likely to be higher. You're already seeing productivity start to rise. So essentially, as I tease through these statements and these numbers and everything else, what this is telling me is that productivity is likely to start to move higher into 2026. It's already doing so in 2025. That means markets can support a higher multiple, and it's bullish for the equity markets in that sense, because higher productivity means growth with relatively lower.
Okay, speaking of the equity markets, a couple things I want to quickly hit and then get reaction to it. The macro, the bigger markets, not moving a whole lot. S&P 500 up 0.1%. Who cares? What is moving is the small caps, the SML Small Cap 600 Index. We don't talk about it a lot. It's up 2%. Here's why I'm talking about it, Francis, because small cap stocks, domestic American companies, almost entirely all their revenue is in the United States. Those stocks tend to move at the later end of a rate cut cycle. So I want you to comment on that move as well. And here's the other news. The 10-year yield didn't move at all. It's at exactly 4%. It moved down 1/100th of 1%. In other words, if you're out there looking for mortgage relief, you're thinking, let's wait and buy a home because mortgage rates are going to come down. The bond market is saying you might be out of luck.
Well, you have two issues in play here. One is that this market already priced in pretty significant easing from this Federal Reserve. So today was just meeting the expectations already in the market. You're going to have to out-ease those 5 cuts that were already put in if you want to see additional support coming through. But the second is, we've talked about it on this show before, we've got fiscal dominance in play, and that long end of the curve where mortgages are more tied, in fact, fully tied, far less sensitive to what the Federal Reserve is doing and much more to what government is doing and what Washington is doing. So we may want to pay attention more to shutdown risks, budgets coming through if we want to focus about mortgage rates than we do necessarily the Federal Reserve.
Gary Cohn on CNBC earlier today said something very, very smart. Says a lot of smart things, David, but one of the things he said today was that we've got to remember the Federal Reserve, this rate call that we're talking about right now, the reason that we dragged you all to New Jersey, This is the overnight lending rate. It's like basically tomorrow. What our audience mostly, what JP Morgan's client base mostly cares about is what happens down the road. And the longer-term bond market isn't moving.
No, but this is actually good news, because our great fear, I think all of us, is that the Fed becomes political. They cut short rates too much, and everybody says, you know what, we're off to the races in terms of government debt. We're off to the races in terms of inflation. That would cause the long-term rates to go up.
But we already did that. That's exactly what we did in 2020 and 2021.
We've got a 4% long bond 10-year yield. That is not high. If we lost Fed independence, it would go much higher. If we had more inflation, it would go much higher. And the other thing that I think is important here is the fact that we only got one dissent to this decision makes me more confident that all this talk about not reappointing the Fed presidents, that's not going to happen. The Fed as an institution has a lot of strength if it holds together, and I think it will maintain its independence and, and try to be apolitical. It's not a Republican Fed, it's not a Democratic Fed. They really want to do the right thing by the economy, and the fact that there was only one dissent today, I think really suggests that they will be able to do that. So I think it's very positive for markets and actually will help hold down long-term rates.
Fair enough. I just wonder, Jim, and we've all been doing this a long time, okay? You've got AI that's sitting out there. We don't know what that's going to do to the labor market. Right. We have a labor market that was wildly overinflated during COVID because companies overhired. They were terrified of what's going to happen. They held on to employees. We saw 10-year yields go to what? Under 1%, David, as the Federal Reserve left its foot on the gas. I hope we can all agree, way too long. Way too long. How much visibility, Jim, do you have and your team have on the American economy right now, given the cloud of AI? I have no idea what the economy is going to look like in 5 years.
Yeah, so it's a good point. So effectively what we're going through right now is a capex-driven cycle. We have
$500 billion to AI infrastructure alone.
A lot, right, a significant amount. We haven't seen this since the 1990s, right? So many people in the markets haven't even seen this. We have a capex-driven cycle. You asked about small caps. You were talking about that. Look at non-farm. Look at the small business confidence levels. Small business confidence is going up. Mid-sized company confidence levels are going up. The reason is that you're starting to get labor at a reasonable price. Labor is coming into the market, so the participation rates are moving higher. CapEx, AI, which is really driving the CapEx cycle, and it's driving a lot of the economy. Workers are going to start to come in 2026, and they're going to come in with labor costs relatively stable and low. For companies, that's a positive. I can't emphasize this enough. This is driving margins higher, which is why equities are where they are today, and they're able to look through all this noisiness in the markets today. So what does AI do? Nobody really fully knows, but it probably leads to higher productivity. Better growth, lower inflation, higher margins, supports a higher multiple.
Yeah, Steve Leishman still in D.C. Maybe you can expand a little bit on that, or by the way, just whatever you want, because I hope the point is well taken that coming out of COVID and then going right into kind of the age of AI, how much do the Federal Reserve officials that you talk to almost every day, either publicly or privately, express concern to you that it is harder now to gauge the economy? Because I don't know, maybe they do, what the ultimate impact of things like artificial intelligence, like robotics, like those things are going to be on the American economy.
When I talk to Fed officials about AI, they say put it on the list, Brian, for things that we're uncertain about. We haven't talked about the impact of immigration on the job market. The job market may be perfectly healthy given the immigration levels that we have, even though the Fed is looking at downside risks here. I think, by the way, that's something that stayed the hand of some Fed officials that are saying maybe we shouldn't be cutting more than one other time this year because of the idea that we may be at a break-even rate of 20, 30, 40,000 a month, maybe the right number given what's happening on the immigration side. AI would add to immigration, would add to tariffs, and you can see a line in the statement that says the economic outlook is uncertain or highly uncertain. I want to pick up on something David said, which I think is really important. The idea that Bowman and Waller did not vote with Myron on a dissent for 50, I think is very important. It does underscore that at least those two officials are more interested in the institution, in the independence, than they are in getting the job. I think that's a big thing, because what we've seen in the past, Brian, is you have a Fed official who dissents and they make their dissent known, and then they come back into voting with the consensus. We've seen that a lot. One other thing that was not mentioned around the table, which is we're now in a position for the data to do a whole lot of talking here. If the economy weakens further, the Fed is probably well positioned here. The market is probably well priced. If it doesn't weaken further, then I don't know that I would be on the board with saying we'll get another 50 basis points. As we remember, we're running 3.3% on GDP on the tracking for the Atlanta Fed. So I think there needs to be some considerable weakness to lock in that additional 50 basis points this year.
So a couple of headlines here. And Francis, I want to reiterate to our audience, there's a lot of information coming out very quickly, that 7 members of the Fed said no more rate cuts this year. And I think 1 called for 1 more, 2 called for 1 more. That doesn't sound like a Federal Reserve that's like, let's just lower rates all year long. Woo, party's on.
Well, it's not a proper easing cycle as we might have think of it. I'm also wondering.
Could be one and done.
I'm wondering.
Could it be one and done?
What is the reason to do one and done in the first place?
Get the president off your back?
A signal. And I'm going to agree with Steve here. We are heading into a period where we're likely to see the job market is going to stabilize at lower levels. That may be more structural than demand based for right now. And I'm still very concerned about inflation upswings into year end. This idea that tariffs haven't come through into CPI yet, so they won't, I think is very misguided. So this is going to be a challenge for this Federal Reserve to continue with an easing cycle or even a normalization cycle, as they might say it, when the data is not going to be working in their favor on either side of the mandate.
7 calling for no more cuts. I think they call that the dot plots. Maybe the lights have turned out on that Fed light bright, as I have referred to it. Jim, David, Francis, really appreciate your insight. Let you get back to your day jobs.